There's a company in India that makes drones for the Indian Army, not the kind you fly at a wedding. We're talking military-grade surveillance drones, remote-controlled weapon systems, drones built to operate at 17,000 feet in the Himalayas. And it's available in the unlisted market right now. The company is called Gamma Rotors. Founded in 2018, they design and manufacture UAVs and weapon systems exclusively for the Indian military, paramilitary forces, and state police. Their flagship drone, the Minibot, is compact, rigidized, and already deployed in the field. They have a titanium-bodied variant. They have a night operations drone, and they've already sold over 500 drones and trained more than 2,000 soldiers. This is not a concept company. The product exists, the customer exists, and the customer is the Indian Defence Forces. Now, here's what makes this interesting from an investment standpoint. The Indian drone system is projected to grow at 35% CAGR between now and 2030. Defense is the largest segment, and post-Operation Sindoor, the government has unlocked over 40,000 crores for emergency defense procurement. The money has to go somewhere, and companies like Gamma Rotors, which are already qualified, already deployed, already trusted by the armed forces, are directly in the pipeline. But the more interesting story is actually in the financials, because this is where Gamma Rotors genuinely surprises you. Its two listed peers, ideaForge and Droneacharya, both reported losses in FY25. ideaForge lost over 62,000 crores, Droneacharya lost over 13 crores. The broader drone industry had a difficult year, election year, slow government procurement, delayed orders, and yet Gamma Rotors, a fraction of the size of both the companies, stayed profitable. Positive EBITDA, positive PAT, in the same environment where bigger, better funded players were bleeding money. That tells you something about the operating model. They manufacture using 3D printing and CNC machining. They run a virtual catalog instead of physical inventory, which means near zero inventory cost. It's lean and it shows up in the margin. They have also cleaned up the balance sheet dramatically. A few years ago, the company was almost entirely debt-funded, classic early-stage manufacturer running on promoter loans. Today, the balance sheet is virtually debt-free. Equity came in, debt went out. On valuation, using a revenue-based approach with a discount applied for the unlisted status and smaller scale, the intrinsic value works. It works out to roughly rupees 122 per share. The current unlisted price is around rupees 106. So there's a gap, and whether that gap closes depends entirely on how the next 2 or 3 years play out. Whether the revenue scales, whether the new capacity the company has invested in starts generating returns, and critically, whether they capture a meaningful share of the procurement wave that's coming. Now the risks are real too. This is a small company. Revenue is still under 15 crores. They're almost entirely dependent on government contracts, which means order timing is lumpy and unpredictable, and the unlisted space means liquidity is limited. You can't exit on a bad day the way you can with a listed stock. But sometimes the most interesting opportunities are the ones the market hasn't gotten yet. Profitable, debt-free, already inside India's military, and available before any IPO buzz. If the procurement wave post-Operation Sindoor plays out the way it looks like it will, this one could be worthy watching very closely. So you stay updated and keep watching us for more such content on ShareScart.